I am Jeffrey Roach, Chief Economist for LPL Financial. In this Econ Market Minute, I'll give you 3 highlights of the past week and 3 potential market movers for the week ahead. Let's start with 3 highlights of the past week. First and foremost, markets had a tough time digesting the inflation report this past week. CPI inflation dipped to 8.3% year over year in April from 8.5% in March. But the decline in year-over-year rates was not as much as investors wanted, and investors were conflicted. 10-year yields spiked up 15 basis points at 8:30 a.m. when the report was released, and then eventually dropped back to where they were earlier that morning. Key details include airfare, which rose over 18% in just 1 month after strong price increases in February and March. Consumers pivoted from goods-centric to experiences-centric, so services prices will likely be slow to moderate. Energy commodities, used vehicles, and clothing prices all declined in the month of April, giving a soft break to the consumer. The rate of change in inflation cooled, which is a good thing, but markets wanted something lower. Next major inflation metric will be the PCE release on May 27th. Second, a strong US dollar helped offset some inflation pressures to import prices in April. Industrial materials make up 32% of import prices, and prices in this category fell 0.5% in April. Consumer goods, excluding autos, which is roughly 25% of the index, also moderated in April. So the pipeline to consumer goods is likely clearing, so investors must be patient as they await the eventual impact on consumer prices. Third, the University of Michigan sentiment fell to 2009 lows. Inflation expectations are putting consumers in a sour mood. More consumers believe personal income growth in the next 1 to 2 years will not keep up with price increases. Also, housing activity will likely cool in May, as more consumers this month believe now is a bad time to either buy or sell a house. So during these times of heightened volatility and uncertainty, investors must pay close attention to what consumers do rather than what they say. The Federal Reserve is in a tough spot as they attempt to stay true to both mandates for price stability and full employment. If spending holds up, the Fed can still hike rates and get the Goldilocks scenario for 2022. 2023 may turn out to be a different story. So bottom line, spending data will be key to determining if consumers will shut down the spending as much as they say. Talk is cheap, watch consumer behavior. Now 3 potential market movers as we preview the week ahead. First, on Tuesday, we get an initial glimpse into retail sales for April. We will most likely see an increase in sales for April, driven by higher gas prices and a return to travel-related spending. Second, we get one of the first major housing insights for the current month of May. The National Association of Home Builders reports on such leading indicators such as prospective buyers traffic, which took a hit in April. So pay special attention to this detail within the report. High home prices, high borrowing costs, and high construction costs all weigh heavily, especially on first-time buyers with no existing home equity to use. Third, the Philadelphia Federal Reserve publishes their business outlook for May. The supplemental comments at the end of the report are golden for investors. This Fed branch includes special insights from business leaders, such as specific budgetary impacts from higher employee benefits and percent changes to budget costs on raw materials. Be sure to note such items as those businesses who had increased total compensation by more than they originally planned. See you next time for 3 reviews and 3 previews.